welcome to this week's series of Credent Connect. And today we want to do a little June recap. This has been a regular cadence for us where we cover markets, economy, whether it's on big dislocation days, right? Whether it's geopolitical conflicts or just basic market recaps, week by week, month by month. Important to know, for you to know where we stand, how we're managing portfolios, and kind of how we view risk. Joined as always by Alisha Norris, our senior portfolio manager. And Alisha and I are both on the investment policy committee here at Credent Wealth, right? Our job is to ensure we provide our advisors with the best tool bag of solutions in the industry to ensure they're navigating the markets and navigating situations for clients on a day-by-day basis. Without further ado, then, let's go ahead and get in the June recap. I'm going to share my screen here. Again, similar format as in the past. And part of this recap that we're trying to do here and kind of bring in some of the charts is bringing a little more light into some of the data analytics that we look at, how we view things, how we talk about things, and you're getting maybe a very marginal sneak peek into the day-to-day of the investment policy committee. And what you're seeing in front of you are three separate lines in this line chart, with that green line being the equal weighted S&P 500. We'll explain what that is. The white line being the regular S&P 500 you hear about in the news, and the blue line being just the growth index of the S&P 500. Think of those bigger, growthier names, your big tech names, AI, buzzwords like that. And on the y-axis there, those are the performance total returns for the month of June. And what you're seeing is the S&P 500, that white line, finished down negative about 3.1% for the month of June, at least here through June 25th. Whereas the average stock, that equal weighted index, finished positive 1.6%. So without trying to confuse you any further, Alisha, I'm going to pivot to you and ask you, how is it that the equal weighted S&P 500 did a very nice, right, 2% for the month of June almost, whereas the regular S&P 500 that we all hear often in the news was down over negative 3% for the month of June?
The market cap weighted S&P 500, the one that everyone talks about on the news, is very heavy in certain growthy sectors. So when we think about the month of June, we saw declines, the largest declines in the technology sector, the consumer discretionary sector, and the communication sectors. And why that's important is because when you look under the hood at the S&P 500 and what makes up the vast majority of that index, the top 10 stocks in that index, which is roughly 40% of the index, are concentrated within those specific names. So those specific names that you see here, NVIDIA, Apple, Microsoft, they really pulled down the market cap weighted index and led to that underperformance in the month of June.
Yeah. So what you're seeing here is ticker SPY, and a ticker that you can buy for the S&P 500. And we're not promoting this ticker, nor is it a recommendation. It's simply a very active and liquid ticker that showcases how the S&P 500 is comprised. And what Alisha is saying is these are the top 10 names that make up over a third of the index. So 10 names make up a third of a 505 name index. When those names do poorly, the quote unquote market does poorly. That's not what happened this time around, though, when you look at the average stock. What that average stock is, it looks at NVIDIA in the same light as something like a Home Depot. They're looked at as the same weighting. In this case, that panned out quite interestingly. So thank you for that, Alisha. It's always fascinating. You've likely heard us talk about before on how we favor that factor profile, right? When we use the word factor profile in allocations, all we're saying is something that is not market cap weighted, which ensures that we are avoiding some of the concentration that can be generated from some of these concentrated names. So without spending too much time on that, I think another major topic here in June was simply talking about the geopolitical environment and what's happening with the war in Iran as a direct function of oil prices, right? So you're seeing this great mountain and then this steep decline. Maybe walk us through a little bit. What are we looking at here? What are those green lines? And why is this now potentially a non-event, Alisha?
So what you're looking at here is the price of oil. What you saw leading up until February of this year is that the average oil price over that time frame was around $62 a barrel.
Hmm.
Once we had that initial crisis at the end of February, you really saw that initial spike upwards. And during that time frame of that crisis, which would start around the end of February and go through, I would say early or middle of June, you
Yeah.
saw the average price jump up to the average price be around $92 a barrel. So we
Yeah.
really saw that spike in $30 averages. The interesting part is now that risk premium is being baked back out of the market, right? Because we're having some resolution. The price of oil is almost to the same price it was before the crisis. So when we were talking to you all back in March and April, one of the things that we said is crises can cause massive dislocations in the market. And you're looking at one in this chart, right? And one of the things that we said was stay invested, don't make rash decisions. And I think this was a great lesson of why you shouldn't overreact to market events.
Tremendous lesson, right? Dislocations happen all the time. And I'm gonna pivot back. So if you just, keep this chart in your mind, that big spike there in March and April, right? That big spike, I'm gonna change this chart to year to date. That big spike in those oil prices coincided with this massive downturn in the market. I use the word massive very loosely in this case, in that a less than a 10% downside is by no stretch massive. But the point is the correlation of the freakout moment was very much intact. So as we look at that dislocation piece, as we see the reasoning why, right? When there's a definitive reason why, that actually tends to be a much better dislocation. And we took advantage of it, right? We implemented structures and portfolios to take advantage of a downturn in oil prices. It actually happened way faster than even we anticipated. We expected it to go maybe another 3 to 4 months. Fantastic news. Very good to see this happening. Great for the consumer backdrop as we head into year end. With that notion of heading into year end and kind of tracking the economy, markets, so on and so forth, uh, June revealed the GDP data for the second quarter, right? Excuse me, for the first quarter, the GDP data for the first quarter that was actually finalized. And GDP expanded at a rate of 2.1% here in the first quarter annualized. By the way, that surpassed estimates by a fairly decent margin on the part of economists, because as we mentioned before, I think we're in this limbo where economists are throwing some things on the board, on the dartboard rather, and seeing what sticks. And that can be good and bad. In most cases, it tends to be bad if you're following that as pure investment advice. But it's important to break down the composition of US GDP by expenditures here. And Alisha, I'm going to pivot back to you to talk a little bit about this recent composition here, which, by the way, GDP is comprised of consumption, investments by businesses, government spending, and net exports, right? Going back to our econ class in fifth grade, that is how GDP is constructed. Why is that composition important in this particular quarter? Kind of where did that attribution come from mostly?
The biggest attribution in the first quarter came from investment. So think about that strong investment in data centers, for example. I think that is the biggest, newsworthy. Everyone is talking about AI. You can really see that investment in blue being the biggest contributor to GDP in the first quarter. One of the other interesting points that you might notice is the white piece, which is consumption. So how you and I spend money, right? What are we buying? What you'll notice going back to the third quarter of last year, you'll notice that is dwindling down. I think it's important to understand that consumption is slowing, but I know that you have some comments, though, on how that isn't quite true yet in the earnings piece.
Yeah, absolutely. And on that consumption front, if we think about the why we're equal weighted mostly, why we're not cap weighted, think I'll give you a perfect example, right? If I am a business and then I need, and Alicia is selling semiconductor and chips, and I need those for my technology and I need those to revamp my business. If I buy those semiconductors today, Alicia's business will see an immediate profit. Whereas me, I have to capitalize that cost over 5, 7, or 10 years, ergo, expecting a future productivity or efficiency profile down the road. So there is a lag in that structure of revenue and growth in the economy from the expenditure, right? One company sees immediate profit, whereas the other company is now going to see that span out over multiple years. As we're seeing that expand, right, I think there's going to be more volatility in the various tech names, appropriately so. But what we saw happening last quarter from a general earnings backdrop, and what you're seeing on your screen here, this is from February to May of 2026. It's the S&P 500 companies by sector and their earnings profiles. So here we have sales growth and earnings growth. These green numbers, what those green numbers mean, how did companies in aggregate in each sector, how did they report earnings relative to what the analyst expected them to report? So, for example, in the consumer staples sector, think of names like Ford, like Walmart. Think of those individual staples names in that particular sector. Expectations for growth were lower than 8.97%. Yet they surpassed that growth profile in the actual results. The green data is very positive in this case. Here's what's interesting, right? Exuberance like this cannot continue in perpetuity, right? Exuberance like this cannot be sustained in outpacing expectations in perpetuity. We know that. We're prepping for that. And the hedging and the insurance in portfolios and managing at the allocation and selection level is exactly how we're expecting the next 6, 12, and 18 months to pan out. And it is a function of knowing and managing through the companies that are spending the cash to buy technology versus the ones that are capturing that profit right away. So as always, we will stay on top of all of this for you in the portfolios. We will forever keep building that tool bag where our advisors can always deliver above and beyond client expectations. We'll talk again soon.